This Week in Startups is brought to you by HostGator, your one-stop shop to getting your business online. Your domain name, your website design, even your marketing, they've got you covered. Have questions? Their team is there 24/7 via chat, phone, and email to help you. Start today with 30% off with coupon code TWiST. And Walker Corporate Law, a boutique law firm specializing in the representation of entrepreneurs. Visit them at walkercorporatelaw.com. Today on the show, Jalak Jobanputra, managing partner at FuturePerfect Ventures, is back and talking to our incubator class about raising capital and navigating your funding options.
That's what it's all about, man. They said money is the root of all evil. What? Funny how it feeds my people. We ain't gonna live like equals until we get the money, spend the money, and defeat you. Yeah, money is the root of all evil. What? Funny how it feeds my people. Yeah, we ain't gonna live like equals until we get the money, spend the money, and defeat you.
I would want to keep this very interactive, but when Jason asked me to speak, I just thought of different topics where I get asked a lot of questions from entrepreneurs, and one is just it used to be pretty simple in terms of raising capital, right? You did a seed round, you raised an A, you raised a B, you raised a C, and you knew where to go for capital. And now we have, whoops. Anyway, I can switch this. It's supposed to be a murky soup of lots of different things other than alphabet letters. And so thought today we can spend some time talking about all the different funding options that are available that we hear about. And I've been investing for 17 years since 99. I started off at Intel Capital, so I was doing corporate venture 9903 out here. Moved back to the East Coast, joined a fund called New Venture Partners, which commercialized tech out of corporate labs. So very kind of incubation, hands-on models. And then was at the New York City Investment Fund, which is a public-private partnership. And so over the years, before I started my own fund, just have been at a number of different types of funds, and through the years seen different models. And I do think that it's important for entrepreneurs to not just follow what everybody else is doing, but and especially now that there are all these options, to figure out what makes sense for you as the team. Has to do with personalities. It has to do with what your goals are longer term. Do you want to grow into multi-billion-dollar business, or are you happy keeping it smaller? And that's not necessarily a bad thing, right? I mean, everybody's driving for this big IPO these days, but it's not necessarily for every company and every business. But luckily, there are lots of different funding options these days. Why is this? There we go. So, flavors of funding. These are, probably not a comprehensive list, but ones that I've picked out that entrepreneurs access. So, you have friends and family. You can read this all the way through right now what we're seeing as the pre-IPO rounds, which are these, hundreds of millions of dollars going into companies in the hope that they'll, IPO in the next year or two. And there are all these things in between, including angel list and crowdfunding, venture debt, corporate money, and again, great news. These are all out there, but you need to know the right questions to ask. Friends and family, it's often where entrepreneurs go for their first funding. I think I read a statistic that like 87% of businesses go this route and not any further. Sometimes they bootstrap with this capital, and we forget that when we're in this high growth tech world, right? That convertible note is often the funding, at least that I've seen in the tech world. And I have pros and cons. And excuse, I'm glad I'm not getting critiqued on the design of the presentation, but I did this on the plane. So you have early believers and folks that are passionate about your business, but the challenge is around emotional tax, right? If you know people really well, and are they going to be bugging you all the time? Are you going to feel guilty if it's like your grandmother's last $10,000 that she insisted on giving to you? So I think it's really important to make sure that you've outlined the risks and kind of the boundaries of and try to treat them as much like any other investor. And it's also good training for the future in terms of investor updates and setting those boundaries, because you want to be heads down building the business and not managing investors all the time. Angels. And when I have the amount up here, you can also chime in on what you see with angel lists, right? It used to be that angels put in, I'd say even $500,000, and now we're seeing, much larger syndicates made up of angels. Structure is often the convertible note, and so there's no kind of no overt valuation discussions that are happening, although the cap is, in effect, a way of valuing the company, but it's kind of punting to the next investor. So the pros: domain expertise. You can get folks, and we heard it here tonight with real estate. Getting folks from the industry who are engaged and can help you provide that industry perspective is a great thing, and something that was harder to find if you were sitting in say Iowa or somewhere where you couldn't access some of these experts before, and now you can. They're often very passionate individuals, which can also be a con because you also need to manage their enthusiasm and make sure, and everyone has an opinion, right? And that's what I always tell entrepreneurs, that even if I'm telling them something, like they need to filter it, because I bring biases through all my experiences. Every investor is going to do that, and so one of the biggest jobs of an entrepreneur is to filter through that, and that's really what I also look for in an entrepreneur is are they going to be able to filter through all the noise that's coming their way? And angels are often a big source of some of that noise. And the other thing I'd say to be careful on is who takes the lead. Now, you may not need a lead necessarily, but it's often good to have somebody who's kind of leading the efforts, and whether it's structuring the deal or kind of corralling, even if it's not a formal board, but a board of advisors, and making sure that you have somebody driving the business forward from the investor side, because we saw this with party rounds, right? A few years ago. I don't think that happens quite as much anymore. Never happened in New York to the extent it happened out here. The entrepreneur didn't know who to go to, right? Or there were too many, cooks in the kitchen. That's the phrase. And that, while it may be good from pure money, it's can be really detrimental to kind of helping figure out how to move the business forward. Now, grants is something I threw in here because I do see companies who go down this route, especially in the life science space, and actually education. I do a fair amount of ed tech funding, and it can be a great way to go, but and I don't think any of you would be in this category, but it can be strategic. It's non-dilutive. You don't have to give up any of your company, but you do have to give up time. In terms of applications, there's often milestones you have to hit. It can be very project-based. But it still does work for certain companies. accelerators, like the one you're in. Although, do you call this an accelerator? It's yeah. So I actually think this is an ideal format, and not just because I'm here, but this kind of closeness that I see here is what I think that accelerators should be striving for, right? It's that being close proximity, helping each other, listening to each other, seeing the progress, providing feedback, but not in a forced way, is kind of the ideal setup. The challenge is sometimes you can have too many mentors, too many folks giving you advice, and I think the bigger the accelerator, sometimes the more folks that are being brought in and paraded through, and everybody has an opinion, and so I have it as a pro and a con, because you can get some great value from them, but they can also kind of confuse you more about what should happen with your business. Demo day, pro and con, because it is very much a milestone, and only a milestone, but sometimes it can be just moving towards that milestone and only focus on that milestone can keep you from exploring other elements of the business, which you may be able to do outside of that environment. So I think even if you're in an accelerator, it's important to keep that in mind, that the demo day is not the be all and end all. It's only kind of the beginning of the process. Alumni, I think, are fantastic in these accelerators. And there are more and more that have vertical expertise, which are fantastic. And all about the advantages of that.
Hey everybody, let me stop for a moment and tell you about HostGator. You can stop thinking about the business you want to do and you can just do it. The first step is web hosting and a domain name from our friends at HostGator.com. It's a one-stop shop for your online business. You can set up WordPress, drag and drop builders, easily set up custom email addresses. They have in-house design, SEO, and PPC, pay-per-click services. So as you grow, you'll be able to easily transfer from your $4 a month shared hosting account, and you'll have dedicated services, VPS, all that great stuff, 24/7, 365-day a year live support via chat, phone, or email. We love them so much that TWiST is hosted with them. That's right, it's super affordable compared to things like Amazon. They have reliable service, and we've had a really great experience with them. It's super quick to get set up, and everything is clearly explained and very nice and neat with screenshots and everything. The first 100 TWiST listeners that sign up with the promo code TWIST25 will receive 1 year of HostGator hosting package for just $25. That's right, TWIST25, and you will receive the 1 year of the HostGator hatchling package for just $25. This includes tons of disk space, unmetered bandwidth, MySQL databases, and multiple custom email accounts. So don't worry, if you're not one of the first 100, you can still save 30% using the promo code TWIST. Thanks again to our friends at HostGator for hosting thisweekinstartups.com and for providing all this great service to our listeners. Go ahead and thank at HostGator on your Twitter handle. Okay, thanks again, HostGator. Let's get back to this amazing program.
So crowdfunding, again, this doesn't look, relevant for any of you guys, but it's an interesting statistic that I'm not talking about equity crowdfunding. I'm talking about the Kickstarters of the world. The average raised on these is something like $7,000. And we always hear about the success stories of, the Pebble. I don't remember how much Pebble raised. But it's actually really small dollars. Requires a lot of marketing effort. You don't have dilution. It's market research, but I think it actually can be very expensive market research to manage. Often, it works really for hardware product companies, not software. Micro VCs, so that's what I am these days. And it's a new asset class that's just emerged over, I'd say, the last 5 years. And these funds and micro VCs are broadly defined as being under $100 million of managed capital. What's been exciting about that market is smaller funds that have more flexibility in terms of what the return profile is. So venture funds, I raise money from investors and invest that money, and the expectation is within a 10-year period I've returned how much I raised plus at least like a 6 or 7x. I mean, most people, say that they'll do more, but in reality, most venture funds are much below that. And so there's pressure on VCs to be able, look at their portfolio and return that capital back to their investors. When you have when you're putting in smaller amounts, and you don't have you don't have to have that 100x exit. You can invest in companies that have smaller exits and still be able to return money back to your investors. And so I think it's actually more aligned with most entrepreneurs. The challenge is having enough capital to be able to keep following on. And I think that's something that entrepreneurs should certainly ask the investors about. But the micro VC market's really stepped in and filled what I think is a gap as companies are more capital efficient. But they provide like institutional discipline to the companies and will come in and value. I actually I don't do convertible notes anymore. I'll go in, I'd rather just go in and price the round. And so a lot of micro VCs will come in and step up and do that. And the other thing I'd say is that they will work with other investors more than some of the larger funds do, because there are less stringent ownership requirements. Some of the larger funds will require that they own 20% of your company. Whereas because the return requirements are a little bit more flexible, micro VCs often will syndicate with others. And I think in the early stages of a company, it's useful to not be wedded to one person or one fund and start exploring what that relationship is like. I could have used other analogies, but I stayed away from that given Jason's previous advice. And then I'd say one con here, which is going to appear next, is the portfolio approach. And this is something I always stress to entrepreneurs. I mean, this is your baby, this is your company, this is your life. I mean, VCs have a portfolio, and they're de-risking what they do by having that portfolio. So, you just have to keep that in mind and make sure that you understand that. And I actually think again, I'm going to talk highly of micro VCs because that's the route that I chose. But I think micro VCs are able to not place all their bets on one or two companies in their portfolio and be able to spread it out more because of the way they're structured. Okay, larger institutional VC. So the amount is, we keep seeing this go up more and more, right? Where it used to be that Series A was, these $3 to $5 million rounds or $2 to $5 million rounds. Now we're seeing these at Series A rounds at $6 million, $10 million, $20 million. So I don't know why it said TBD, but the structure, often, it's most likely equity, so any notes will convert over. They'll price the rounds. So you're getting a lot at this stage, right? You've proven out product market fit. You have customers. If you're getting money from an East Coast fund, you have revenue. West Coast, maybe they don't they don't care about the revenue as much, but you've gotten some traction. So you're taking on an investor that you believe you can partner with that will kind of take you to that 10 million plus revenue number. And this is, I'd say, I mean, early stage investors are important, but this is like one of the most important decisions you make, because often it's one lead that'll come in. I mean, these days, because the rounds are bigger, sometimes you'll see co-leads. Spend time with them, get to know them, make sure you're aligned in where you want the business to go. I have seen so many companies with so much potential just not be able to get there because their investors just didn't believe in the same vision or wanted to guide the vision in a separate direction. And I do think you can have those conversations during diligence and get a sense of what that investor is thinking. And maybe you'll change your mind, but it's so important to be aligned at this stage. And you have to keep in mind they're looking for those 10x returns. So get ready to 10x plus. Get ready to build a business that that will get there, and sometimes that means you have to step aside, or and that's something I would do in the diligence too, and see, some investors have that model, others, give the entrepreneurs more leeway, and not that doesn't happen in every case, but these are all important discussions to have at this stage. And also, the last point I have is the fund life cycle, which is important. If a fund has just raised a fund and they're investing out of, you're one of the first portfolio companies in that fund, you will have more leeway and more runway. If you're at the end of that fund, depending on how the rest of the fund has performed, you may have a lot more pressure on you. I think it's easier to find out these things, and just by, I think there's a lot more transparency amongst supportive investors on this. But this also matters, and that's kind of out of your control. So it's just a good thing to know where you fit in a fund life cycle.
Hey everybody, let me stop for a moment, this amazing episode, and tell you about the Walker Corporate Law Group. Yes, they are a boutique law firm that specializes in the representation of entrepreneurs and startups. And Scott Walker is the founder of that company, and he is a personal friend of mine, and he does a great job working with startups. I have literally introduced him to dozens, maybe hundreds now, of startups, and they all rave about the services of the Walker Corporate Law Group because their lawyers have decades of experience. You're not going to get junior associates who are getting on-the-job training with your startup. No, they're going to help you with mergers and acquisitions, licensing, terms of service, privacy policies, formation, all this kind of stuff, fundraising, and they're really great at it. And they do fixed fees. They don't want to surprise people with crazy bills. They think that billable hours can reward inefficiency, so they'll just be fair with you. And that's what I love about them, because if you're a startup, you don't want to get that sticker shock and get a huge bill. Make sure you use the Walker Corporate Law Group, and you can do that by calling Scott Walker at 415-979-9998. 415-979-9998. You can email him, scott@walkercorporatelaw.com, or you can visit walkercorporatelaw.com as well. Scott@walkercorporatelaw.com, and let Scott Ed Walker on Twitter know, @Scott Ed Walker, know that you watch the program and you appreciate him supporting independent media like This Week in Startups. One of my oldest advertisers, one of my oldest friends in the industry, just a great guy, a total mensch, and he really takes care of the startups who work with him. Thank you, Scott Walker, for supporting This Week in Startups. Bye-bye. Okay, let's get back to this program. Come on.
So I've seen corporates now come in at all stages, including early stage. That's why the 500,000 plus rounds, they're more likely to come in at an A and after. And usually will participate in equity rounds. I think they can bring tremendous value. I think they also can create signaling risk and can help like block out other investors and partnerships if they structure investments that way. Like Intel Capital has been doing it, I think, the longest of any corporate VC. Ones that have been through different life cycles. I think they know the business. They're not just getting into it when the market's good, which happens every cycle. I mean, now I feel like every corporate is raising, has a venture fund. But I think it's important to know who sits on the investment committee and what the process is. I mean, at Intel, you had and probably still have, the Intel CFO and, Les Videz, who was one of the founders, who was, employee number 3 there. So, there was real commitment there on Intel's part, and there are, lots of other ones that have been around for a long time. So, I think that's important to know. I would not sign any onerous, like right of first refusal, where if you get, it's not a bad thing to do that. If you get an acquisition offer, they will, they want to be told and be able to match it, but they shouldn't be able to block they shouldn't be able to block transactions like that. And so there are just a lot of nuances where you want to make sure they don't have too much control. If they're on your board and competitors come up, you should have them recuse themselves, and that does happen, or they'll take a board observer role. So again, the more experienced corporate VCs will flag these things for you, but if they're newer in the business, they may not. And often if they do help you with business development, they may ask for warrants, additional equity. But I don't necessarily think that's a bad thing if they're helping you get revenue, right? But it should be tied to that. Venture debt. So in a market like this, we see a lot of venture debt at the later stages. I mean, it's like Silicon Valley Bank, Square One, where later stages where there is revenue and or assets that you can borrow against, and it's non-dilutive, so you're not giving up any more equity at the later part of your business life cycle, and you're getting capital in. It could be line of credit, be helpful if you need to get some cash in on an interim basis. What happens, though, in a down cycle is pretty scary with these, where, and this happened in 08, post-08, with a number of companies in my portfolio, where they had financial services firms as customers, and they just canceled their contracts. Most of these companies had some venture debt, which got pulled, and because the startups weren't able to meet, the ratio and covenants, and basically, had to repay the debt, and just didn't have cash, and nobody was willing to invest. No new VCs were willing to come in, and so again, that's like an extreme situation. I hope we don't get to another environment like that again, but it happens every down cycle. So I think you have to be smart about the covenants. Right now it's very much an entrepreneur's market, and being able to negotiate these, because these venture debt providers want to get some exposure and build relationships. If you do IPO and they can be a lender to you in the longer term, that is good business for them. So I'm a fan of it. I think you just have to remember that times may not always be so great. Pre-IPO, these are rounds we're seeing right now. 20 million plus, large pools of capital, often coming from JP Morgan, Fidelity, these large financial services firms. And their goal is to really take the company, help infuse capital to get the company to IPO. Could mean expansion internationally. Challenge here, which I don't think is being discussed a whole lot right now, or may have just started to be discussed, is the liquidation preference. So when VCs now invest, they get preferred stock with, they get their money back first at a 1x of what they put in. With a lot of these structures, they're getting 2 to 3x first, and then the rest of the investors get their capital, and then the common stockholders get theirs. Now that's in an acquisition scenario. In an IPO scenario, it all converts to common stock. So I think, even as an early stage investor, I get concerned about this trend, right? Because if there's an IPO, it's usually fine, right? It's large enough that it'll cover, all the investors. But if things do start to rationalize a bit, then it also impacts returns for an earlier investor. These guys have lower return expectations. It's more of a 3 to 5x, but they also look for getting their money out quicker than your earlier investors. And I have this one, which I took it from Mattermark, and it's just shows how allocation of capital has changed over the last year, which is a lot more has gone to the late stage, and we know that from the headlines. I think, and again, I'd like to hear your perspective on what you're seeing, but I personally think, anecdotally, what I'm seeing is that there is, a lot more conservative behavior on the part of angel and seed investors, and because some of them are still waiting for liquidity. That's kind of filtering down a bit, and then people are looking for sure bets and more milestones. What are you seeing?
I think at the late stage, it's that investors from all over the world, whether high net worth individuals or sovereign wealth funds, they see how much returns have been generated on the private market, and they all are starting to crowd in there and try to deploy money, so valuations just go up. Sometimes they don't want to pay the high valuation, so liquidation preferences go up. I think also I see a few different bubbles happening. There's one there, I think at the early stage valuations are also high. Some savvy investors, or maybe they are not, but they start to pull back and are now trying to be a little bit more price conscious. And then as I think about the middle range, like Series A, there are a lot of smart people who are making the argument that it doesn't really matter what you pay, because there are only 20 companies each year that generate all the returns. So if you get into it at 30, 40, 50, 60, whatever $1 million valuation, who cares if it hits 50 billion?
Yeah, and I that's where, and maybe it's the micro VC perspective where I don't agree with that mentality. I think there is actually more companies than ever that are going to generate returns for investors, right? And so yes, there are only a certain number that are going to hit those billion-dollar marks, or billion's nothing anymore, but the hundreds of them with the decacorn. What do they call them? The decacorns these days, right? But I think that I would rather, in a lot of ways, be investing now than ever before, and even as an entrepreneur, you have more options than ever before for where you go for funding. But I again don't necessarily. I like when my companies IPO, but been around long enough to know that that's not going to necessarily happen that often, or it can take a long time. I mean, I have two companies I invested in the late 90s or 2000 that just IPO'd in the last couple years. That's a long time, right? I mean, they made it, but it's you know, somewhere along the way, would it have been smarter to sell, or you know, probably not, because I like the fact that they're independent and you know, out there, but you know, that sometimes gets lost in this market right now. That you know, you hear about this compressed time to IPO, and yes, that's happening, but it's not going to happen forever, and it's just, I think what matters the most is building a sustainable business and finding the investors that are philosophically aligned to get you to that milestone or goal, whether it's selling in, that's not a popular thing to say in the Valley, but selling, you know, in a couple years at a nice little return, or, you know, going all out. Okay. Any questions? I feel like.
Well, let's go for Jalak. I had a question right off the bat, which is, how do you evaluate deals in this market, deal with the high valuations of this market, and then who are you competing with? Who are you coming up against most often?
Yeah, that's a great question. So the valuations scare me, partly because of where I am in the market, which is this micro VC, right? So I don't have this unlimited capital, and I will get diluted as a fund, you know, if these later stage investors come in and, you know, take these 2 to 3x liquidation preferences. So I'm still pretty conservative on it, and luckily, you know, I'm not in the Valley, so it's, you know, I think there's a lot more rationality outside. You can argue that maybe the opportunities aren't as, you know, I mean, there's definitely a lot of talent out here, and I still think there are going to be lots of great companies spawn, you know, in the Valley. That's never, I don't think that's ever going to change. But I also am not so valuation sensitive that, you know, right now I'm doing an A, which is not at a micro VC valuation, but I think it's going to be huge, and I will participate in that. I'll have a smaller ownership, but I will make sure I get rights to follow on and keep investing. But even having a small piece, you know, at a higher valuation in you know, certain companies, I think is worth it. I just think it's there are a lot that are not going to grow into their valuations, and so I don't do a lot of that. You know, most of my companies are, you know, sub 20 million, usually sub like 10. You know, I'd say sub 12. But I've gone out of that. Who do I
pass the microphone? Who's got a question in the audience? And where's the microphone up there? Here we go. Perfect. So let's pass out. We have a question from the audience. We're soaking it all in. You didn't answer who you come up against.
Yeah. Could I? I mean, so the one thing is that it can be, it is more collaborative in micro VC, right? But I also, and I mentioned this to you when we spoke before, I want to invest in companies that I'm passionate about, and that passion comes through both ways, right? It's me communicating that to the entrepreneur and thinking of ideas, you know, before I even invest. I think it's obvious to them, right? And then. And so I don't view it as compete. You know, it's not. I haven't run into a situation where I get blocked out of something that I really want to invest in, because it's usually because I have conviction and passion around it, and you know, if there's an opportunity to do that. I mean, I think when I was investing at funds that were leading, you know, in A, it gets a lot more challenging, where, you know, the companies are going to choose one. You know, one investor. You know, I've had one where I put, you know, I've led three deals, and there were competing term sheets at higher valuations, but they liked the experience that I, you know, brought to the table. And usually by the time I get to that stage, it's pretty clear.
What are the easy no? Oh, good, May. You have a question? Go ahead.
So you mentioned that you no longer do convertible note, but convertible note is getting popular for seed round for early stage companies. It's easier so that companies don't have to prove
Yeah.
the valuation. So can you explain a little bit more why you don't
Well,
do
so
that? And
yeah, I don't think there's anything necessarily bad about them. I understand why companies do them. I especially think when a company is figuring out product market fit and is tougher to value. I don't think there is anything wrong with it. I just invest at the stage where some of that data is there, or I'm comfortable doing the work to try to figure out a valuation with the entrepreneur. And I like to know what my ownership is, because what happens, and this is true across the board, and the next stage investor can come in and completely change everything, right? Change all the terms. Again, it's less likely to happen in this kind of feel good market right now. But as a fiduciary, I manage money for other folks. I want to know what my ownership is, and I'm willing to work it out with the entrepreneur to figure that out. I've made a few small exceptions, but not these days. Yeah.
You mentioned signaling risk a couple
Yeah.
times, but you
Yeah.
didn't really talk about that too much. Can
Yeah.
you talk about where you should watch out for that?
So yeah, I think. So it came up a few times. One is on the accelerators, on corporates. It's just what the decisions you're making and who you're taking funding from, or whether you're getting funding from certain folks, can just impact how other investors view you, right? So if you're going through an accelerator and their funds invested in that accelerator, but none of them, has decided to fund you further, or if you have a corporate VC involved, that then a competitor corporate VC may not invest, or there may be LPs in that other fund. So I actually think to the investors who are really smart, I don't know how much it matters. As an investor, I would do diligence. It's definitely a flag. It's like if you get seed funding, and that's why I think Andreessen stopped doing a lot of seed funding, right? Because what they were finding is if they were just investing in a lot of companies and not necessarily spending time with them. And so when it came to the A, they didn't know the companies as well as the rest of the market thought they knew them. So if they thought they were passing, when I've talked to some of these companies, they just went elsewhere for funding. And so I think as an investor, you can dig around and figure out what there are sometimes explanations for this, but if there's also not a ton of diligence that's being done in this market, so it's an easy way for people to say no, right? And so I think you always have to figure out, it's like life in general, right? You have to figure out why anyone would say no and counteract that before they actually do. Did that answer your question?
What's the worst behavior you're seeing historically?
Oh, wow.
On
That's a long list.
on either side of the equation. Could be entrepreneurial bad behavior, could be VC, angel bad behavior, incubator bad behavior. What are the things you've seen that would be the war stories that we could learn from and or be appalled and entertained by?
Yeah, you do. So, just generally speaking, one of the things that bothers me about this market is that I view that there is a lot of mistrust, and because there have been some bad stories, and there always are going to be bad stories, right, of investors leading entrepreneurs on, going through the process. I've heard this from lots of entrepreneurs where there are some investors who'll just meet with them to get information. They may be looking at competitors. When I meet with a company and I've met with a competitor and still haven't made a decision, that's what I start the conversation with, and just say full disclosure, I met with so-and-so, I'm interested in the market, I haven't made a decision, right? But that bothers me that investors are out there doing that. And, I think confidentiality, the only way you stay in the business in the long term is like respecting confidentiality and both sides, right? So that trust is I wish there was more of that in this market. I've had entrepreneurs say, I won't give you, I look for cap tables. I need to know who else is, what ownership other investors have, because I also need to figure out, are they going to try to take more in the next round? Like there are a lot of dynamics that happen, and that's why I'm asking for the cap table. I'm not asking for any other reason other than, my sense is some of these entrepreneurs have gotten burned by, cap tables being passed around amongst investors. And so the fact that that behavior happens and it, hurts when you're actually trying to do your diligence, that bothers me. I've seen, later stage investors block acquisition offers, because they're not hitting the targets they need to, and they have the voting rights to be able to do that. There was one particular situation that post 08 is several of my companies had, their debt called on them, but this one did. There was a later stage investor who is still investing, and I'll never invest with him again because he had blocked like 3 acquisition offers while the economy was tanking, and then just went ballistic on the entrepreneur when the company basically sold for $10 million, when they could have sold for $300 or $400 million just a couple months before, even during the downturn.
So if an entrepreneur has the chance to, let's say, raise their seed round at $5 million from brand name, investors, or they get some amazing, crazy offer for 50% more, $8 million valuation or whatever, 60% more. What should they do? How should they evaluate that? Because equity is important, capital is important, but also having great people involved is important. This has been a big debate. Where do you stand on the side of the experienced investors at a moderate valuation, or unexperienced but with great terms? What would you do?
I don't think there is one easy answer to that. Some of the factors I discussed, brand name VCs can bring a ton of value. They have a great network that they can bring to the table, but the question is, are they going to do that for you, right? And a part of it is just seeing, what else they've invested in, how much time they're going to have for you. Are they going to delegate to their junior staff to, and how hungry are they? That's also important because there's some brand name investors who, are collecting nice fees and don't really need to do a whole lot for their portfolio companies. So. But I don't think you can underestimate the value. I just don't think the value is as readily apparent as you would necessarily think it is.
Is there a way to ensure that the value is broad, or to mitigate against taking one of these brand name venture firms, but maybe getting the junior partner, or not getting the support you need? How would you go about letting them know, like, hey, I want to take you at a lower valuation, but I want X, Y, and Z?
Well, I think talking to other entrepreneurs that, have worked with that partner before, and that's what, I hear from a lot of entrepreneurs who talk about some of the, the bigger names, and how once they did their diligence, they were not, as enamored by them. And there's also one particular deal that I'm looking at now that a very well-known VC undervalued them in a significant way just because he could. And, I don't think that helps the entrepreneur. So I don't think you should optimize necessarily for the highest valuation number, because, we could do a whole session on like term sheets and how value, there are a lot of other things you need to pay attention to other than just valuation. including option pool conversion and how convertible notes convert. I think you need to make sure you're getting fairly valued and you're not, the VC, however well known he or she is giving you a fair deal and not discounting it because of who they are, because I think that's just going to backfire at the end of the day.
Is that a New York issue, you think? Because here, I mean, the valuations are extremely
yeah,
high.
They're really
In New York, maybe you've experienced that, where a brand name in New York is
oh yeah
maybe.
well
You operate in New York, yeah.
yeah. No, I mean I invest out here.
Yeah, too. Yeah.
I believe a lot in the valley and the talent out here, and it's just easier when they're local, and I feel like I can build the relationships. I'm very, like I said, I want to be passionate about the business. I want to engage. I want to be very engaged and thinking about the business, and it's much easier to do that if you've gotten to know somebody over a course of time. So, but I will invest out here. New York is very different right now. It's we have less VCs. And I mean, challenge is all the West Coast VCs coming in and giving these crazy term sheets to the entrepreneurs there. But
Okay, let's hear it for our speaker, Jalak. Well done.